I'm CA Shafiq Nilail, your PDC leader. Okay, I'm here to introduce the next speaker, Yusuf Hassan. I don't think he needs any introduction, at least to this audience. John has already mentioned that he is our family member, but as a formality, I have to read out your profile. Yusuf Hassan is a partner in KPMG and IFRS specialist. He heads the accounting and finance team of KPMG in the UAE, the division that provides a comprehensive service offering to support clients on accounting and reporting issues. He has held over 100 engagements on the implementation of IFRS 9, IFRS 15, IFRS 16 in the region, and has provided advice across all sectors, including financial services, oil and gas, retail, and real estate. Yusuf is the Middle East and India for KPMG Global Revenue Topic Team that addresses all practice issues on IFRS 15. He also provides advice and structuring option to clients. He advises regulators on compliance matters as well. Yusuf is a specialized IFRS trainer and has won the prestigious ICAI Award for Excellence in Training of Financial Professionals. He is a chartered accountant of both ICAI and South Africa CAS. He has been a KPMG partner in the region for 13 years and served on the regional KPMG IFRS desk for 9 years and for 3 years on the Africa desk. He also worked at the South Africa Institute of Chartered Accountants for 3 years and lectured accounting at the largest university in South Africa. He did his articleship in another Big Four firm and worked in their technical department. Yusuf Hassan, please.
Thank you for that introduction. I brought my IFRS book, Chairman George. It's 2,185 pages, including the index and the glossary. If you can't sleep at night, you should read this book. My students, when I hire an intern into my team, they very diligently on the first day take out the book and want to read and learn the book. And I learned some Indian words, and I'll tell you what word I tell them. I tell them chordo. I learned some words, right? I can't share all the words I've learned on this forum, but I learned chordo means leave it, right? And I say it with tone. Indians are very passionate, right? And the tone of the Indian accent can chordo. So different ways you can say it, you can achieve different impact. So from them, I tell them, don't ever do that. How you will learn to embrace the standards is by application. I want you to dig into these books, all 2,185, to find an answer to a question. If you never read IAS 41, it's okay. It's okay. No one has read IAS 26. I promise you. You know what IAS 26 is? It's accounting for retirement funds. If you're the pension fund, you'll read it. I even asked the ISB, why are you keeping this stupid standard here? The point is, look, the way to learn these things is by going into them. But there is also a big problem. Which standard do I go into? What standard, if I have a situation on cloud computing, which standard do I go? If I've got Bitcoin, which standard do I go? If I'm holding gold, which standard do I go? You know, I've been an IFRS practitioner for many, many years. I think it always came to me in the firms. Even when I was a junior, they said, look, this is difficult, Yusuf will deal with it, even in the old days. So all my life I've attracted these things, but I've learned something. I have to carry the book with me everywhere. Because we professionals tend to have overconfidence in our abilities. And I'm going to quote, when I think of IFRS 15, I sit on the global topic team of IFRS 15, right? And everybody thinks they know revenue. I promise you, everybody thinks they know revenue. But it reminds me of a quote by Donald Rumsfeld. And I'm going to paraphrase that and put a little bit of my own masala, right? There's things we know we know. There's things we know we don't know. Like, I don't know what's the capital of Argentina. Oh, maybe Buenos Aires. Okay, I don't, but there's things we don't know. We know that we don't know. And then there are things we don't know we don't know. There are known unknowns and unknown unknowns. And in IFRS 15, I think there's a lot of unknown unknowns. I think it's not 2,185 pages, but that's one of the more difficult standards. I was discussing this morning, I said IFRS 16, technically it's easy. There are some small complexities on sale and leaseback. There are some small complexities on lease modification. It's an easy standard to apply. IFRS 2 is slightly difficult, but you figure things out, you can get there. IAS 19 is complex calculation. IFRS 15 is difficult. It's difficult. And the way people approach it, there's an inherent bias in it. And my worry and concern when teaching people IFRS 15 is that the sense of overconfidence in not knowing what we don't know. Listen to this, and I'll explain to you this with a problem. But let me tell you what I'm going to try and talk to you. I've got an hour. I want to start with IFRS 15. It's not a new standard, as Paddy said. We've worked with it now for 4 years. Maybe I've worked with it for 8 years. I can tell you some of the problems and the challenges we have in IFRS 15. I see some of these clients, I've given you opinions on these already. They won't change, inshallah. IFRS 16 on leases, I will talk to you a little bit about it. And if I have time, there's been a very, very interesting structure that has been going on in the market, which companies have been using, the oil companies, the real estate companies for monetization, which is, people are using it all the time. They're getting money they're getting funds into their company without getting a debt treatment by applying the finer points in IFRS 15 and 16. But this is extremely higher grade. If we get there, we get there. If we don't get there, don't worry. All right, don't worry about that. I'll just cover 15 and 16. But if we get there, I will try to explain to you some of these complicated structurings. But let me start with IFRS 15. IFRS 15 is about revenue recognition, right? Revenue recognition in the good old days was easy. When I speak to older chartered accountants, they tell me it's common sense. What is common sense? I don't know. Look, there is a way that people approach it. IFRS 15 is called revenue from contracts with customers, right? Most cases, people in finance haven't even read the contract. No, look, I mean, every time you buy an app, you're ticking a box that says, I agree to the terms and conditions. Who here has ever read those terms and conditions? No one. When we're assessing the IFRS 15 answer, we have to read and understand those terms and conditions. But let me give you an example, a simple example. I'm not trying to play the consultant game where I see problems for every solution, no. Let me give you a simple question, and I want to test how people look at revenue, right? Let's look at this question. I came here today on an Uber, right? From my home in Jumeirah Park, I came over to the Dusit Thani. I took an Uber. My question is about revenue recognition, and I want to use this example to tell you the biases and the way people think. Revenue recognition is not about the amount. There is the amount, you will recognize the same amount and stuff. The big thing about revenue recognition is when you recognize revenue. Sometimes auditors tell me, oh, no, it's the same number over 3 years. But it does matter. So here's the question on Uber. So Uber, the moment I say I'm going to Dusit Thani, I get this guy saying, Mohammed will be your driver. Your price will be 320 dirhams and my credit card is booked. Mohammed drives from Jumeirah Park over here to the Dusit Thani in Abu Dhabi. Price is about 320 dirhams. The question is, Uber is the company. I'm not going to ask the question what Mohammed gets. Then I get into a complicated principal versus agent question. But I want to ask the question, when should Uber recognize the 320 dirham as revenue? The day Yusuf goes and clicks and says, hey, listen, I'm taking this thing, it's non-cancelable. I get into the car, I've committed to the trip. Do they recognize the 320 dirhams there? Do they recognize the 320 dirhams when they at Dusit Thani? Or do they apply a percentage completion basis? On the 17th of September, it doesn't matter. But let's assume, I'm going to change this, right? Consultants complicate life and then give solutions, right? Let's say this was at 31st December. At 11:53, he picked me up. There's a cutoff issue. How much revenue must he recognize? Which period? Whose bonus, whose EBITDA is this revenue going to sit in? Is it going to sit in 31st December 22, 31st December 23? Or if at midnight I'm at Deerfields Mall, should he be recognizing 200 out of the 320? So this is the problem. This is the revenue problem. I've oversimplified it. You know, sometimes the complicated people in London say I oversimplify the issue, but accounting is simple. It's got to account for the reality of the transaction. According to the principles, not according to my women fancy, and I'll talk to you about women fancy a little later. But how should we recognize the revenue? Conservative accountants will say always wait till the end. Conservative accountants, and we have a lot of these, and they will tell me words like prudence. Let's wait till the thing is over. We will recognize it till the end. They say, let's be conservative. You know, my response to that is IFRS is not about being aggressive or conservative. It's about fair presentation. Listen to this. It's not about being aggressive or conservative. In fact, now when we're going to be paying tax, you're going to see people more conservative in revenue than aggressive, if they were the other way. It also depends whose bonus or where the number is going to come to. And this, maybe I'll remind me of a story on EBITDA. I'll tell you maybe in the leases section. But here's the problem is, some people will say this is non-refundable, non-cancelable. You've committed to the guy has come there. Look at the cancellation terms, you've got to recognize it up front. And then some people will say percentage completion. Some people may even get more complicated. There's two performance obligations perhaps there. One is for the driver, one is for the car. There isn't, but they will say that. Some people may create a principal agent question. I know you guys want the answer, right? The answer depends. Listen, but what I'm trying to tell you is instinctively, as accountants, we provide one of them. And there's two things we didn't do. One, we didn't read the contract properly. And secondly, we didn't read the standard. If I had to read the standard, the relevant paragraph, I believe, Paddy, correct me if I'm wrong here, is IFRS 1535 capital A. If there is a service being provided, does the customer consume the benefits as the service is being provided? Which means if he gets stuck in Gantut, does somebody else have to re-perform the service and take me back to Jumeirah Park, or how does it work? If 35A applies, he can apply percentage completion. If it doesn't, he doesn't apply percentage completion. I'm not trying to complicate the issue. What I'm trying to say is, in my experience in the adoption of these two standards, a lot of times the CFO or the finance division is not party to the contract. With the leases and the revenue contracts, we're not party to that contract. We come too late sometimes. You know, in the first year when IFRS 15 came out, I went to the telcos. There was going to be a massive impact on telcos. And the marketing departments wanted to kick me out of the building. Because you were changing, from an accounting perspective, what the marketing department thought they were selling. You understand it? So these things, look, we're not even reading the contract. This is what I'm saying is, if there's a lesson I learned, is finance has to be involved in every new product. We need to know what the debits and the credits are. You understand that sometimes marketing thinks, hey, this is a great campaign. This is how much it costs. This is when we're going to recognize revenue. So look, IFRS 15 is more complicated than we think it is. It's not just a matter of upfronting or delaying. You understand that. This is a very, very difficult standard that requires 5 steps to be taken. You need to take the 5 steps. And I'll tell you, maybe let's get into the 5 steps. The 5 steps, what is the 5 steps? It's very difficult to read the standard. It's based on US GAAP. So it's an interspersion of rules and principles, and they try to create a flow chart for how to tackle a revenue question, right? And this is in the standard, but it's how to tackle these things. And I'll tell you, there's problems in different industries for each of these points. But the first step says identify the contract, identify the performance obligations, determine the transaction price. These first 3 steps are done in the contract. It doesn't even, before even an accountant touches anything, you're sitting in the contract. You have to understand the terms of the contract. Step 4 is some accountant work comes into play. And step 5 is recognizing revenue, either at a point in time or on the percentage completion. Those are your only 2 options. Nothing else. Today, I'll tell you how we apply this. If I look at clients generally, they determine the transaction price and they decide how they're going to recognize revenue. We haven't understood the contract parameters and boundaries. We haven't even understood the scoping. Is this the right standard I should be in? IFRS 15 is a residual standard. What does it mean? IFRS 15 applies to something that's not covered in the other standards. Because it's such a complicated generic standard, go to the other standards first. Only if something isn't covered there, come help me cover it here. You understand it? So if your bank is giving you something for free, let's say it's giving you products for free. It's giving you a bag or something like that. It's not selling bags. Or maybe a different answer. Is the bank, when the bank charges you an interest rate and charges you a documentation fee, it's no documentation. Nobody's going to the bank to get documents. It's actually part of the interest rate. You should be assessing that transaction cost in terms of IFRS 9. Don't even bother about IFRS 15. You understand the point that I'm saying is the analysis of IFRS 15 is residual. Think of whether it's covered somewhere else before you come into the standard. And then you go into step 1 is identifying the contract. And this is interesting. It's very, very interesting because people don't understand this. I've seen this, and I'll tell you where I pick up identifying the contract. Sometimes what you used to see companies do is they give multiple deliverables to people. Let's say I want to service a client in Iraq. All right? I need to provide capital, I need to provide repairs, maintenance for their equipment. I need to provide training for their staff. I may, because Jordan is the closest country to them, I may put the Jordan service of training through the Jordan entity, and I use the UAE entity to price my repairs and maintenance. And I price one cheaply, and let's say the total contract value is 5 million. I price the Jordan one at one price, and I price the UAE one at a different price. I price the Jordan one cheaper. Why? Because there's tax. But the offering to the client is the single offering. You understand it? That's the contract boundary. Do you understand what I'm saying? Is sometimes we put 3 or 4 products together, but we're in fact selling one. I'm giving you free. Yesterday the iPhone 14 launched. Before IFRS 15, you know what phone companies used to do? I'll give you a free phone, but you sign a 2-year contract with me. If the phone is for free, leave it outside with the cookies and the coffee. It isn't. Although it sits on a separate piece of paper, that piece of paper must be stapled to that service contract. And why if you go today, you're not going to see any telco doing this. Because why? Even though there's two separate contracts, one's for the hardware, one's for the service, you can't get the free phone. You understand? That's a performance obligation question, but what I'm saying is when I identify the contract, I have to staple those two pieces of paper together and saying the customer. And this is another point. Who is the customer? IFRS 15 is revenue from contracts with customer, right? What is the customer getting? The customer is getting a phone and 2 years of service. Although it sits on two different pieces of paper, I need to combine that contract. That's when I identify the contract. Yes, I may split it up again in step 2 and step 4. Hey, but look, the performance or the promise is there, step 1. This identifying the contract is very, very interesting. When a few years ago, this was still when BlackBerry was around, I wanted the free BlackBerry. I went to I said, hey, listen, give me the free BlackBerry. No problem, they gave it to me. There was a taxi driver who wasn't given the free BlackBerry. And this is step 1. I'm giving you an example. Why? Why didn't they give the taxi driver the contract? Maybe his income wasn't enough. There is an implicit finance sale of a phone. We don't think you have enough income to support the payment of this. You understand the concept here? So, step 1, identify the contract parameters, understand the rights and obligations, account for those rights and obligations. Sometimes I may have to split the contract. Sometimes I may have to put it together. The gym contract I enter, I go to fitness first, I pay 1,000 dirhams up front. I then have to pay a 300 dirham per month. The gym companies tell me they want to recognize the 1,000 dirhams up front. Okay, why? I've given you a 2 dirham plastic card with your photo on it. I've written and filled in your form. They tell me what activities they have done. What activities you did is not important in revenue. It's what did the customer get. The customer got a 2 dirham card. Does that 2 dirham card have value to the customer? No, it doesn't. The value is in that 300 dirham monthly fee. In fact, let me give you the answer. People don't like this answer. That 1,000 dirham is an upfront collection of 3 months' fees. There's no separate benefit the customer is getting, although it's called admission fee. What am I going to do with that admission fee? I need to get access, which I will pay monthly for. This is important. So I say read the contract to understand it. And look, 2 companies don't have to be the same. One big criticism of me when IFRS 15 came out, oh, we're not comparable to our competitor. You shouldn't be. Your contract is different. You can't be. If your contract was exactly the same, then your accounting is the same. If you're giving something extra and he's taking something extra, it's different accounting. So this is what I'm saying. Step 1 is important. And maybe I'll give a problem. I think I've given you some of the problems in later slides. I'll tell you, I've identified some big problems in people's application of the standard, and this one here, substance over form. Some clients come to me, I don't want to read the contract, substance over form. What do you mean? Where do you get substance? See, when I see clients tell me the substance over form, generally they want to get to the answer they want. They say, oh, substance over form. I want to get my intent. What is substance over? I agree. Substance over form means account for the transaction in a faithful way. Account for the rights and obligations economically as they are meant to be accounted for. That's what substance over form means. You understand that? So it doesn't mean go and take some magical intent. So I read the contract, they tell me, no, this paragraph here, the guy is not going to look at. He signed it. My intent is to do this. How can your intent not be captured in the agreement? If that's the intent of both parties, oh, he'll never apply this purchase option. If he'll never apply that purchase option, take it out of the contract. He won't. So it has substance. You understand that? So I'm saying is substance means account for the rights and obligations that exist in a faithful manner. not a devious manner. But anyway, coming there, back to so that's contract. Performance obligations in the last year and a half has been one of the biggest problems we have. Biggest problem is highly subjective. See, the whole of IFRS 15 is about accounting for the performance obligation. The Uber driver's performance obligation is what? Is it to transfer Yusuf from his home to the hotel? That's his performance obligation. And for me, the best example of performance obligation is in gift vouchers. I go to the Virgin Mega Store, I spend 200 dirhams on the gift voucher, I buy the gift voucher. I give it to my friend Paddy or give it to Krishnan. Yes, 200 dirham gift voucher. When I go to Virgin Mega Store, let's talk of debits and credits. Can they debit cash? Yusuf has paid them 200. Can they debit cash? Yes. Can they credit revenue? They put a big sign here. Hey, listen, this thing is non-refundable. Now, what's the scenarios? One, Paddy goes and redeems the gift voucher. He buys a iPhone cover. Then he can recognize the revenue. Let's say Paddy keeps the gift voucher in his pocket and he goes to the laundry and goes completely washed out. He goes back to Virgin and says, hey, I've got this little piece of stuff here. Give me something. They say, we don't have anything. Can they recognize the revenue then? The concept of revenue will only be recognized when the performance obligation to the customer is discharged. The mistake that people make, gems, everybody, is what I am doing. The gem is saying, I am spending so much time opening your account, allow me to recognize revenue. The customer got nothing from filling in the form. There's no benefit in the customer filling out the form for you. You understand this concept. And the performance obligation, so even if the gift voucher expires to Paddy after 2 years, only after 2 years can Virgin Mega Store recognize that revenue because the performance obligation is discharged. But here's the big problem. When do I split this performance obligation? And this is challenging. I promise you, this is not easy. We have massive, massive debates with clients on when do we split the performance obligation. The guidance is complex. The wording is, can the customer benefit from the good or service on its own or together with other resources that are available to the customer? And then second is the promise to transfer the good or service separately identifiable from other promises in the contract. So these are, you got to read this twice or thrice to understand what it means. A few years ago, Demex sold a property. They put a big hoarding outside the Mall of Emirates. Buy this property from me for 2 million dirhams, I'll give you a free BMW. Right? Does Demex sell BMWs? No, they don't. They will give you the BMW today, but they will deliver the property in 3 years' time. Can you benefit from the car without the property? Yes. But I even want to go further. Why would companies do these kind of things? One, it's an incentive. But another thing, logically, I'm going to go through commercials. You see, accounting doesn't exist in a vacuum. And revenue taught me this. The reason they're giving the free car is because, look, that sales of that property has dropped. They sold the original ones at 2 million. The market is slightly down. They don't want to sell the next version for 1.8. So when they know, let's throw in the 200,000 dirham car. You understand that? Do they service that? No. But look, identifying and splitting that performance obligation matters. You're delivering the car today, even though Demex, I'm sorry, I'm using Demex as an example, maybe somebody else, but they don't sell BMWs normally. But they are providing an incentive. They are promising two things to give the customer. Yeah? Although it's marketing, they're promising the customer 2 items. So even when Etisalat gives you the free phone, they're not Apple, but they do sell in their stores an Apple phone. So you've got to identify this. Now, I'll give you a more tricky example. You go to an electricity company. They want to charge you a connection fee. And then they say, look, we want to charge you a connection fee, and then we'll charge you a monthly service fee. Now, what's the idea behind it? The thinking is, I sent a guy out to connect you. He cost me some time and labor, therefore I want to recognize some income. From the customer perspective, if you connect me and serve me, it's the same thing. I can't go to another electricity company in Dubai, it's only Diwa. You understand that? So from the customer perspective, there's no benefit that is separable from the connection and the service. Therefore, it's only one thing. Therefore, you can't. Even though you've written in the contract and met criteria too, the customer cannot benefit from your connection without your service. And this clients don't like, because they've gone carefully trying to structure to get some income recognized up front. This is why the gym charges that admission fee. They know the average gym goer is going to only last on average of 2 months and 30 days or 20 days or something like that. They know. They want you to go and tie up there. You understand that? This is the point. Sometimes the clients will ask me, okay, if you're telling me not to recognize the connection fee up front, how long must I spread it? And they think that that is the gotcha question. It's not the gotcha question. You know how long. You know, they think because I don't give them a time to spread it over, therefore the answer is wrong. No. So performance obligation distinction is important. The question you got to ask is, can the customer benefit from this on its own? You understand this? And this is difficult. It's controversial. You got to read the contract. You sometimes change the contract. You know, clients sometimes ask me questions saying, look, I don't want to consolidate this, or let me recognize revenue upfront. I tell them you will have to change the contract this way. What clients sometimes expect me to do is, because this is a principle-based standard, to give a wrong analysis. A wrong analysis is not allowed. That's wrong. That's professionally wrong. You change the commercials, give the customer something. So I told the gym guys, look, if you want to recognize some income up front, give the guy a bag. You can recognize the income of the bag up front. Give him a weight assessment. Check his body weight, see how much muscle mass he's got, how much fat he has. Give him a report. That's a service the customer can benefit. If he goes to a pharmacy, they'll charge him 100 dirhams for it. You understand my point here? So we can create deliverables within the contract, but I cannot, in your current form, allow you to recognize things incorrectly. Step 3, determine transaction price. It's not too difficult. The big challenge we've seen here is only when there's variable consideration. Variable consideration means you pay me 100, but if your usage is so much, it goes up or down or something like that, like your electricity. Or variable consideration could be a discount, a trade discount, or any rebate. The standard says, look, if I'm selling something today to you for 100, and I know you're going to take the 5% discount, I don't account for the discount in a later period. I recognize the discount now. What IFRS 15 has done is it's introduced some statistical concepts, 2 statistical concepts, expected value and most likely. You've got to either apply the more predictive of both to decide how much revenue you recognize today. Obviously, if it's all in the same year, no problem, or the same period, no problem. But if it crosses a year, you have a problem. If you're telling your customer, I'm selling you today 1,000 units, but if you buy 10,000 units from me over the year, your unit price will be reduced by 60%. The first unit I sell, do I recognize it at at the full price or at the 60%? This is where the variable consideration guidance comes into play. Another one, and in the construction industry I've seen this, and people don't want to do this because the old conservative accountants don't want this, is this little situation here. If I have a success fee, and I'm entitled to that success fee, I should anticipate it. So say, for example, I'm doing a contract for 100 million, if I finish on time, it's going to take 5 years. If I finish on time, I get a 10% bonus. I apply percentage completion. 100 plus 10% bonus. I am 50% complete. Should I be recognizing 50% of 100 or 50% of 110? This was controversial when the standard came out. The standard says you should recognize 50% of 110 if that's the expected value. It's not about conservatism, oh, let's be conservative, wait for it to happen. And the rule of the standard is you should be virtually, reasonably certain it will not result in reversal. Which means the way people who are trying to avoid the problem saying, oh, let's just forget about it, let's wait, because we don't know. You do know. If you've got a history of completing on time, then at the 50% stage, you've got to be recognizing 50% of 110. If you don't have history, khalas, no problem. Recognize the 100. You understand the thinking here? So, and it's interesting, it's not always the conservative answer is right. So this is the issue of transaction price. If there are embedded financing options, you've got to account for the financing option. I'm going to sell Krishnan this little thing for 100 dirhams. You take it from me today. You pay me in 3 years' time. I am financing him. When should I recognize revenue? Today. How much? That's the transaction price, is how much. The transaction price is the present value of the 100 over 3 years at whatever the interest rate. So I will say debit receivable, 100 dirhams of 3 years, let's say 89. That 89, credit revenue 89. Today, I sold you the goods. That additional 11 will come in as interest income over time. Over the period, it's 100 is 100. Some people say, no, give me the 100 on day one. No, I can't give you the 100 on day one. You understand that point here? So it's very, very interesting. Sometimes, like the airlines industry, a customer may have a pre-delivery payment. In that case, you are funding the supplier. In that case, there's a different issue. That funding income, and this time we never thought about this. We used to always know the discounting effect, but that implicit funding of the asset or in shipbuilding or whatever forms part of his revenue. His revenue is going to be more than he collects if there's an implicit funding element. So those are some of the complexities in step 3 that we don't pick up. But as I said, my biggest challenge is step 2. Step 4, nice little exercise, is allocate the price to the performance obligations I've identified. So in the DAMAC situation, I'm saying, look, I'm getting 2 million from the customer. I'm giving 2 things. I'm giving a car and I'm giving an apartment in future. The revenue that I need to attach to the apartment is the value of the apartment. Not the 2 million, it's the 1.8. And the 200 is the car, which they must go collect from the BMW dealer. I'll just be the conduit for it. The point is, the allocation has to happen. So even in the olden days with the telcos, when they gave the free phone, they gave the phone today. The service contract is for 2 years. You have to identify the price of the phone. You have to identify the price of the service contract, and the discount will have to be proportionately allocated between the 2 elements. When do you recognize revenue on the phone? Today. When do you recognize the service contract? Over the period. You understand this thinking? The allocation is not difficult. Where I have challenges in allocation recently, I've been looking at loyalty programs. Like think of the airlines. Airlines, Emirates Airways has Skywards points. If people are aggressive, they want to allocate, every time they sell a flight, they want to allocate more to the flight than to the points. Or sometimes the other way around. It depends on their risk appetite or the lack of it, or what number they have a bias towards. You see, if I take a flight to South Africa for 3,200 dirhams, if I didn't have a Skyward points, Emirates' performance obligation to me ends when I take the 2 legs of the flight. Agree? But if I have Skyward miles and I generate 4,000 points from that flight, they have 2 performance obligations. Because those 4,000 points can be used to get an umbrella from them or something. Yeah? If I collect 40,000 points, I may get a one-way trip to Oman for free. But they don't know what I'm going to use it for. So there's 2 performance obligations. The challenging question, which I had with the airlines, is of their 3,200 dirhams, how much goes to the flight, how much goes to this stuff? See, the flight, I'm recognizing it today. And then there's the concept of breakage. Some people will never redeem. Like my wife, she collects so many points, she never redeems. I'm like, I'll take it, let me redeem it. No, I'll redeem it tomorrow. It doesn't get it. It expires. So people like Yusuf's wife will always give income to Emirates. But when should they recognize? They call it breakage. When do they recognize this breakage? I had this funny little question. You know this Magic Planet, right? In Dubai, people play this Magic Planet cards. They come, they tourists. They put 100 dirhams on the card, let's say, right? They never finish the 100 dirhams because the rides are priced so stupidly, 6 dirhams 75 for the stupid basketball thing, right? They never finish the 100 dirhams. The guys who do this, they know exactly in the different countries, Kuwait, Egypt, how things will work and how much of that card will expire. Their question to me is, hey, listen, when? We know the breakage. This card expires after 6 months. So if somebody bought a 500 dirham card and he's still got 90 dirhams left and he hasn't used it, and I know because look, every time we went back to the mall and my kids wanted to play, now they're 20, we'd buy a new card. We'd lose the old one, you know what I'm saying? We'd only find it a day after it expires usually, you know. The point I'm making is, look, when do you recognize that extra revenue? It's not always conservative. Do you understand the thinking? Listen, you got to get there. Finally, step 5, recognize revenue. Revenue needs to be recognized. There's only 2 options, point in time or percentage completion. Point in time could either be at the start, could be at the end. When the performance obligation is discharged. If you could tell me at the gym that the admission fee is giving me some benefit, the day I give you that kit bag, that report, take it, khalas, gone. I can recognize it when that obligation is discharged. If I don't, if I'm giving you only something at the end, I recognize and wait till the end. But then in between that is percentage completion. And for me, percentage completion was tricky. There was only 3 paragraphs in 35 A, B, and C in IFRS 15 that allow you or get you into percentage completion. In the old days, when I came to Dubai, my interview question was, how should the real estate companies recognize their revenue? And the key question was EMAR. And I told them, listen, there's no risk and rewards model. It still was a risk and rewards model under IS 18. They had to wait till the end. And nobody was doing that. Because you had to transfer construction risk. IFRS 15 is different. IFRS 15 gets back to a percentage completion basis because they took out risk and rewards as the primary determinant of transferring revenue. But they also, some people were arguing at that stage, when I came to Dubai in 2007, that revenue must be recognized on percentage completion basis. Why? Because it's a construction contract and IS 11 says when there's cranes in it, you've got to apply percentage completion. That's nonsense. How do you identify it's a construction contract? IFRIC 15, not IFRS 15, define the construction contract as one of those contracts, and I'm oversimplifying that paragraph, where you can kick out the developer. Because in a construction contract, he's rendering you service. Can you kick out EMAR if you're not happy with your apartment on the 93rd floor? You couldn't. Therefore, you can't apply construction accounting anyway. But the old argument was IS 11 because there's cranes. Because I'm doing construction, my promise to you is construction. No, it's not. My relation towards Imar is selling me a good and service at that stage, which needed to be recognized at the end. Anyway, this is IFRS 15. There are various elements. I've broken down some of these elements into some of these concepts. These are the only 3 situations where you can apply percentage completion. Customer simultaneously receives and consumes the benefit as the entity performs. That's where you apply percentage completion, and that's my Uber example. Or then there's another example. Let's say it's my car that the guy is driving for me. That's my car. He's rendering service in my car. He gets sick in Gantut. Guess what? I got to pay him for the service he's rendered to me till there. And he's entitled to it. You understand? It's a different scenario. And then the last one is for specialized assets, and for me was also a specific way they allowed the real estate industry to get into percentage completion without the full transfer of risk and rewards of ownership. What it says, it's quite complicated. It has 2 requirements. The developer's performance does not create an asset for which the developer has alternative use. So he's selling you the unit, it's only for you. And as he's doing this, he creates entitlement to payment for performance. So if he's 50% complete, he can claim 50% in the law, despite the RERA laws. And at the end, and in most cases, the developers would tell us, we've identified the unit, the demand risk is yours. If the developer takes back the unit and resells it, he cannot apply percentage completion. You understand that? Because you're not creating entitlement on an ongoing basis. Then when do you recognize revenue? If you're applying point in time, in the old days, IS 18 days, we used to wait for risk and rewards of ownership. That was the main thing. I mean, I remember, you heard in my feedback, my introduction, I was a lecturer at a university. In that lecture, in my interview, I had to explain to the professors IS 18. So I knew this concept of risk and rewards backwards. I could understand and explain it. And that was the basis of IS 18, paragraph 14. I even remember the paragraph, right? Paragraph 14 required risk and rewards. The new standard doesn't. It says, look, you can recognize revenue at any point in time when the performance obligation is discharged. It can be that, it's a transfer of control, not risk and rewards. And that transfer of control can be evidenced by an obligation to pay, transfer of legal title, physical possession. And there, the substance over form people come and say, no, legal title. It's an indicator. In 99% of my cases on the sale of goods, I still look at risk and rewards of ownership. I still look at risk and rewards of ownership. For me personally, only in the real estate industry, because of this percentage completion, I don't focus on it. That's why the absence of transfer of risk and rewards of ownership doesn't mean I haven't transferred control. If I meet all the other requirements, there's no one silver bullet that gets me there. Again, it's a conceptual discussion based on the contract. Another big problem we have in IFRS 15, a lot of clients come to me. Sorry, am I? Okay, no problem. Okay, done. No. It's telling me 15 minutes. I read it as 51. Anyway, I'll finish off. Just 2 more slides on 15. I'll get into 16. You won't get the complex structuring. I'm not going to give you that. So that's not bad. I see Paddy's breathing a sigh of relief. He's going to teach all his clients how to get things off balance sheet, right? How to raise money and treat it as equity. Contract costs. Sometimes my clients tell me they want to recognize revenue because they incurred cost. And they come with this magical defense called matching. They say we need to recognize revenue now to match the cost. If you read IFRS again and the conceptual framework, the entire drafting of IFRS is balance sheet focused. You recognize revenue when performance obligations are discharged, not when you incur costs. If you've incurred lots of costs in connection, or according to the gym, when they opened up my account and gave me the card, Then they want to recognize revenue. It doesn't make sense. There is no matching. In an expert testimony, if you want to give this to the courts, I can't say, hey, I decided to match it. There's no way in the standards I can get to matching. Only IS 20 on government grants gives me some degree of matching accounting. IFRS 15 doesn't force me to match. In fact, what I found in IFRS 15, there hasn't been a linkage between revenue and costs. In fact, it's much further driven apart. What I can recognize as revenue versus costs. You know, so sometimes my clients tell me, look, I'm setting up this little operation, this little service which I've got to render over 5 years. My biggest cost is mobilization, bringing all the people there, getting their visas. It's all up front. Allow me to recognize the revenue up front. But the obligation to the customer is to service him over 3 years. I can't allow you to match your cost with the promise you've provided. It's just not allowed. Why can't we force it? Why can't we force that to be done? Because your customer is not paying you for mobilization of your staff. You understand? He's paying you for the service, which you've got to provide over 3 years. How you do that is different. So there's no basis of matching to achieve that. Few issues, as I said, substance over form. You got to read the contract. Step one, read the contract. There's no magic bullet that I feel this is how it should be accounted for. That's the substance. No, the substance is derived from the rights and obligations and the common law concepts around the country. Matching. Matching is not a basis for recognizing revenue. Prudence. Some clients say, I don't want to recognize now, I want to be prudent. You can't be prudent. Being prudent or being aggressive is both wrong. Oh, I discharged the the performance obligation today, but I want to wait 3 years. Why do you want to wait 3 years? I want to be conservative. I've had these arguments. I've had this conversation. And they think, oh, prudence, I'm a good accountant. No, you're not. You're misleading the shareholder by doing this. But I don't know what my future costs will be. That's all of us. But your performance obligation has been discharged today. I can't say because I don't know how much I'm going to spend tomorrow. I want to manage my profits. No, you can't. Sorry, I've got substance over form twice. Maybe there was something else I forgot. Options. Another thing, I've seen in some of these transactions, I'm selling you something, but I have an option to buy it back. You'll have full risk and rewards. Options under the new standard does not allow me to recognize revenue because I still have control over that residual. You understand that? So if I don't want to lose control, I'll use it for 3 years, but at the end of 3 years, you give it back to me. I can buy it. Whether it's at market value or whatever, I can buy it. If it's less than market value, it's definitely not a sale because I'm going to take it back at 1 dirham. But if there's an option, you don't have control over the residual and I don't recognize revenue. The missing one was consolidation. So a client came to me and says, I have this very, very toxic asset. I would like to sell it to this company. I said, who's going to buy this junk? All right, kachra, right? Right word? Who's going to buy this rubbish from you? He says, no, this entity is going to buy this thing from me. Oh, great. I even have the sale and purchase agreement. It just didn't make sense. Guess what I found out? He should have been consolidating that other entity. Do you understand the thinking here? Is sometimes in these sale and purchase agreements that are highly structured, we find that there may be other accounting issues. So that's the end of IFRS 15. 1 or 2 messages here. IFRS 15 is not as easy as you think. You need to read the contract and read the standard. It's not easy. It's not like before. Common sense, being conservative is not the right IFRS answer always. IFRS 16 on leases. People are already aware and have been applying IFRS 16. IFRS 16 was a massive change. It highly impacted in the UAE my retail clients. All the retailers, more than the airlines. The airlines priced it in. You know, Emirates Airlines for a number of years were projecting how much their rentals would be converted into interest and amortization. They knew. And they already projected their balance sheet. But the biggest impact it was on retail companies across the world. What it did, it says, look, finance lease accounting for everybody. If you are a lessee. If you got a 2-year lease, it's a finance lease. You're going to have a liability, and then you're going to have a right to use asset. It made sense, and I'll tell you why it makes sense. I'm looking at a client at the moment who owns, let's say, schools. He's got some schools where he owns the property and some schools where he's leasing the property. If I want to look at the return on asset, the right of use answer helps me. You understand it? It helps me in Emirates financials as well. They had, a few years ago when I did the analysis for you, there were 254 aircraft in the fleet. They owned 4. 100 was on finance lease. The other 100 and some odd was on operating lease. Now I've got a common basis for looking at the performance on the airline. I understand the assets better. CFOs love the standard. Bad for the balance sheet because it creates indebtedness. It buggers up your covenants, your debt to equity. It improves EBITDA because you no more have that operating lease expense going through profit. You got interest and amortization. Because you have a liability, you have interest. You have amortization of the right of use assets. So the line items are different. Also, if you are in the early years of the lease, you see, because you get finance lease accounting, what does finance lease accounting do? Even if you're paying the same amount for 5 years, let's say you're paying 100,000 dirhams for 5 years, if you apply finance lease accounting, guess what? Your expense in year 1, if let's say a 7% interest rate, is going to be 108,000 in year 1, and it drops. So instead of booking 100 as expense, your accumulation or aggregation between your amortization and interest is more in the early years and less. So in the early years of a company, you will have more expense than later years. And that's not how business works. You know, let's say you go set yourself up in a mall in Oman or Egypt. Take a 10-year lease. You're building up footfall in the first few years, and unfortunately, the standard is telling you book the largest amount of expense in the early years. This is what clients dislike. But let me tell you what I've been doing. I mean, look, my biggest work in IFRS 16 happened before the standard was released. Now, clients are fighting or challenging auditors to reduce the liability or to make it disappear. Let me tell you how they do it. You see, first, they want to get out of the lease. In the old days, the big technical argument was, is this a finance lease or operating lease? Clients wanted operating lease. Why did they want operating lease? Because they didn't want the liability. Clients don't like liabilities, right? What is the definition of an operating lease? It's a lease that's not a finance lease. The definition of a finance lease is risk and reward transfer, bargain purchase option, all those things, right? Operating lease is supposed to be the exception, but people manipulated it, fine. Under the new standard, because every lease is going to be a liability, clients are trying actively to get out of the standard. Because if I have a 5-year service contract, I don't recognize the liability. Let me give you an example quickly, and I'll talk about this definition. Let's say I have a contract with Xerox for 5 years. They will provide for me a photocopying machine for 5 years. If it is a lease, I will recognize the liability. Let's say I have to pay them 100,000 dirhams. If it's a lease, I recognize the liability for 5 years, and I recognize the right of use of the photocopy machine for 5 years. Let's say it comes up to 420,000. I have a right of use asset 420, liability 420, right? If it's a service contract, I just have an expense of 100, 100, 100, 100. So this is where the first part of structuring has gone into. So clients try to tell me this is not a lease. Now let's use the photocopy example as an example. I've only got 10 minutes. Do I have an identified asset? If I don't identify a photocopying machine, if my agreement with Xerox is, hey, I can provide you any machine, it's not a lease. And you know, in the old days, what we used to do, we used to say, look here, you got an agreement with me to transport your goods. I'll use any of my trucks. And the day I transfer your stuff, I'll put your sticker on it. There isn't an identified asset that's not a lease. You understand the point here? If you don't have an identified asset, so this is one way people try to get out of the leasing standard. The second part is, do you get all the economic benefits? Now listen, this is a way to structure out, because my clients have been saying, hey, I don't want a lease. Let's say I have a plant, all right? And somebody needs this plant does water purification. They only need 85% of my output. I give them that 85, and the other 15 I can do what I want to. Guess what? It's not a lease. But if somebody gets 90% plus of my output, it's a lease. So the other part of the lease definition, see, what we used to say, the lease definition requires you to have an identified asset. Sometimes you can't avoid the identified asset. If you can get out of identified asset, you're not a lease. Then you got control over use. Does the off-taker get all the economic benefits? If the off-taker doesn't get all the economic benefits, it's not a lease. So in that water plant, if the extra spare capacity of 15% can be used by you for whatever you want, not a lease. But don't contrive it. I see clients doing a lot of, and this is a challenge for my audit guys. They have to see if this is substantive. Do you have the right to direct the use? This is difficult. This is the most difficult question in the lease definition. And as I said, this has been something that has kept, the most difficult technical questions for me in the last 2 years has been lease definition. Sometimes the clients give me a brief, I want to get this out of the lease standard. Here's a blank sheet of paper, draft my contract for me. So we try to negate this one. We need to only negate one. It's a cumulative definition. You either get out of identified asset, we usually can't. We try to get out of substantially all the economic benefits. And there we split the benefits into carbon credits, everything, and try to piece these away to get out of the lease. But the third one is hard, right? To direct the use. Who operates the asset? Who makes the main decisions on that asset? And that's a difficult one. Sometimes if the asset is so predetermined, we've got to ask the question, who designed the asset? We go into such granularity. But this part is extremely complex. But this is only people who are trying to avoid the lease definition. Let's talk about the liability. So then I have people trying to minimize the liability. Why? Because it harms them. A lease liability sits as a non-current liability. It makes optically, it appears as you've got more debt on your balance sheet. Even family-owned businesses who don't have debt, who are now on leases, saying, how did I get a liability? The patriarch in the family saying, how did the liability come here? The liability is made up of 3 parts: lease term, lease payments, and discount rate. These are the ingredients. Now, this year, in the last year, I'd have to provide audit support. My audit teams have come to me with complicated cases where I have to help them unravel the client's nonsense or manipulation to try and minimize that liability. The first one they want to play with is lease term. The lower your lease term, the less your liability. So people want to create this argument that this lease is for 1 year. It's cancelable every year. Really? The definition of lease term, I like the IS 17 definition better. The definition, it's similar to the new one, right? The lease term is the non-cancelable period of the lease, including renewal options if it's reasonably certain at inception that you will exercise. So if you're going to put your head office building, going to invest in infrastructure that's going to last 15 years, putting servers that last 8 years, you're telling me it's a 1-year lease? It doesn't make sense. IFRS 16 gives me external and internal indicators to challenge it. But, when the standard came out, people thought they were smart. They said, hey, Mr. Landlord, you can kick me out after 1 year. You put it in the contract, that's bad, that's problematic. He can kick you out after 1 year, which means you're putting your business at massive risk as to tell clients, don't write that. Take the liability. You don't want to be on the street tomorrow because this guy found a better tenant. You understand that? So don't play around with lease term. Lease term, the auditors will catch you. And the standard is right. It says, look, at inception, when you're sitting together, inception for me is a very important period. It's when you're sitting together, what is in the marriage of your minds? If you thought you're going to last 5 years there, and you got 1 year renewable 5 times, and you go invest in infrastructure that's going to last 5 years, and your business plan tells me you're going to stay there for 5 years, and you not got no plans to move for 5 years, it's a 5-year lease, in substance. Yeah? Lease payments. This is quite interesting. So people try to minimize the liability by mixing up the lease payments. So, hey, listen, I'm going to pay you for lease payments and I'm going to pay you service fees. Service fees is no liability. Lease payments is a liability. So let's say I was paying you 100,000 dirham a month for lease plus service fees. Let's change the contract a little bit. Let's make the lease 1 dirham and the service fee is 99,999. Under IFRS 15, like IFRS 16, you got to allocate this on a relative value basis. You can't go tell me the service fee, the cleaning of the common area is worth 99,900 and the 1 dirham. You can see through that. Then some clients would say the discount rate. They try to get a very, very high discount rate. They go in, look, what is the discount rate you have to use for the lease is how much you would pay hypothetically to borrow to fund this using the asset as security in your market, in your current context. It's how much a bank would price it, right? People say, no, my weighted average cost of capital. Weighted average cost of capital is wrong because that includes a cost of equity, which is expensive. You can't give me your cost of equity. But some clients say, okay, my discount rate is 15%. Great, you got a small liability. But the reverse of that is you got a massive interest cost coming through. So I don't suggest that. So look, my point or my thing I'm making here is although people have tried to minimize the liability, the truth is, look, don't. Apply the standard correctly according to your commercial requirements. The lease definition, if you need the asset, don't try and avoid the lease definition. People are trying to structure out to get, some of these big companies that liability gets too burdensome, they're trying to structure out, don't structure out. There are also other structures that people try to create. They try to create the leasing through a joint venture. Why? Because a joint venture is equity accounting. So if the liability sits in the joint venture, all I do is pick up that. The standard is looking through that. There's a special paragraph in IFRS 16 that says, look here, if you're the sole beneficiary of the lease occupation, we're looking through that. It's actually a joint operation. And you pick up the lease liability. You understand what I'm doing? Because in equity accounting, if you've got a company here that's applying, you doing equity accounting, which means you're only picking up your investment, and inside here there is a lease, you park the lease liability with some friendly party of yours. You hope you can make the liability disappear. You can't. So all those structures, we've seen them. We've seen clients present them, but they don't work. Variable payments. Some clients come to me and say, look, I can beat the standard. It's a lease. Yes, I can't get out of the definition, but my payments are entirely variable. Standard says if the payments are sales or usage-based, yes, you do not accrue the liability. But when I read the contract and I see the formula, there's always a base, or there's something called an implied minimum. It's not written like that. It will somewhere say you got to keep the plant operating for at least 900 hours. And then you see the formula says 900 hours cost so much. Therefore, there's an implied minimum lease payment, which is the basis of your liability. Where I haven't been successful is solar plants. So people have the solar plants based on solar input. Even though I know Dubai gets very little rain, I can't get an implied minimum. And this is something I fight with my global desk, but they're telling me, look, variable is variable. There is no liability. Interest rate, we discussed it. I'm not going to get to structured transactions, but I want to leave you with some thoughts here on this. IFRS 16 is a lease, but I think you need to be careful. Have you identified every lease? Leases that people have forgotten about is things like my transport arrangement. I've got this arrangement with the bus company to bus my staff from the labor camp to my offices every day. I've identified the bus. It's got my sticker. It's not replaceable. That's a lease. Another complex area is cloud computing. A lot of my clients came to me and said, we spend a lot of money on cloud. Can we recognize this as a lease? Before, when they didn't have cloud, they could capitalize some kind of asset. Now they're paying the cloud. The question is, do I have a lease? And I'm saying, look here, where in the cloud are you? You need an identified asset. If you have a dedicated server in the cloud for you only, khalas, you have an identified asset. But if you're putting it in the cloud with everybody else, where is your identified asset? They want that answer because the cloud expense is coming as an expense and it's affecting EBITDA. They would like to have it as a lease because they can EBITDA doesn't include amortization of the right of use and the interest on the liability. So cloud, even the ISB has dealt with this. Very difficult for your cloud expense to be a lease. Because you're paying for this, but where in the cloud are you? Yeah? I have to end. Thank you very much. Sorry, 2 more minutes, or what's it? It says 11:58 on my watch. Thank you, Krishnan. Sorry, beg your indulgence. I'm going to have to leave after this. I've got a meeting at 3 in Dubai. But sorry, I won't be able to take questions, but Krishnan, you can pass the questions over. What about you want the BMW? It's interesting, you, eh? What happens to the BMW? The BMW is not, DAMAC is an agent in the BMW sale, but they will recognize revenue on that because they are in effect selling 2 things. Because on day 1, you will get the BMW. So you buy it from me, you can use the BMW, but flip the property subsequently. You can get standalone benefit to the customer from the BMW other than the property, which will be enjoyed or sold on to other person later. Okay, thank you very much.
Thank you, Mr. Yusuf Hassan, for your time and explaining the unknown factors through your practical experience. The difficult standards, IFRS 16 and 15 and 16, thank you for explaining it in a very simplified manner, sir. Thank you for your time. May I call upon our Vice Chairman, Mr. Krishnan, Shafiq Nilai, and John Ipin, our senior member, on the stage to hand over the memo, please.